Hey everyone, and welcome to the channel. Have you ever felt like investing is this secret language that only financial experts understand? That it's too risky, too complicated, or only for people with a lot of money? If so, you're not alone. The truth is, investing is one of the most powerful tools you have to build wealth and secure your financial future. And in this video, we're going to break down the absolute basics so you can go from investing curious to investing confident. We'll cover what investing is, the key concepts you need to know, and a few simple strategies you can start using today. So, what exactly is investing? In simple terms, investing is when you put your money to work for you. Instead of just letting it sit in a savings account where it might lose value to inflation, you're using it to buy assets that have the potential to grow over time. Think of it like planting a seed. You plant a small seed, your initial investment, in fertile soil, which is the market. Over time, with patience and the right care, that seed can grow into a strong, healthy tree that provides fruit for years to come. The most common types of investments you'll hear about are stocks and bonds. Stocks, when you buy a stock, you're buying a small piece of ownership in a company. As the company grows and becomes more profitable, the value of your stock can increase. Bonds, when you buy a bond, you're essentially loaning money to a company or a government. They pay you back with interest over a set period of time. Bonds are generally considered less risky than stocks. Before you jump in, there are a few key concepts you need to understand. Let's call these the golden rules of investing. Rule number 1, the power of compounding. This is arguably the most important concept in investing. Compounding is earning returns not only on your initial investment, but also on the returns you've already earned. It's like a snowball rolling downhill. The longer it rolls, the bigger it gets, and the faster it grows. Starting early gives your money more time to compound, which can make a huge difference over the long run. Rule number 2, don't put all your eggs in one basket. This is the principle of diversification. Diversification means spreading your investments across different types of assets to reduce risk. Instead of buying stock in just one company, you can invest in a fund that holds dozens or even hundreds of different stocks. This way, if one company struggles, it won't tank your entire portfolio. Rule number 3, the long game is the winning game. The stock market will have its ups and downs. Trying to perfectly time the market, buying at the absolute bottom and selling at the absolute top, is nearly impossible. Successful investing is a marathon, not a sprint. By focusing on your long-term goals and staying the course, you can weather the short-term storms and benefit from the market's historical upward trajectory. Okay, so now you know the basics, but how do you actually start? Here are 2 simple beginner-friendly strategies. Strategy number 1, passive index fund investing. An index fund is a type of investment that holds all the stocks in a specific market index, like the S&P 500, which tracks the 500 largest U.S. companies. With a single purchase of an S&P 500 index fund, you instantly own a tiny piece of hundreds of top companies, like Apple, Microsoft, and Amazon. This is a very popular and effective strategy because it's simple, low cost, and gives you instant diversification. Examples of these funds include Vanguard's VOO, an ETF, and VFIAX, a mutual fund, Schwab's SWPPX, a mutual fund, and SCHX, an ETF, and Fidelity's FXAIX, a mutual fund, and FNILX, a zero-fee mutual fund. Each of these tracks the S&P 500 or a similar large-cap index, offering broad exposure to the U.S. stock market. Strategy number 2 is dollar cost averaging. This strategy is all about consistency. Instead of trying to invest a large lump sum all at once, you invest a fixed amount of money at regular intervals, like $100 every month. This takes the emotion out of investing. When the market is down, your fixed amount of money buys more shares, and when it's up, it buys fewer shares. Over time, you end up with a lower average cost per share. It's a disciplined way to build your portfolio without worrying about market timing. So, to recap, investing is putting your money to work. Start early to harness the power of compounding, diversify your investments to reduce risk, and think long term. The most important step is simply to begin. You don't need a huge amount of money to get started. You can open a brokerage account with no minimums from well-known companies like Vanguard, Fidelity, or Charles Schwab. If you found this helpful, be sure to like this video, subscribe to the channel for more financial tips, and let me know in the comments what you'd like me to cover next. Thanks for watching and happy investing!